Financial statements for beginners. The third basic financial statement is the cash flow statement. A cash flow statement, or statement of cash flow, looks at the cash position of the company. It undoes all accounting principles and shows the cash flows of the business. It has three components: cash from operations, cash from investing activities, and cash from financing activities. It answers the questions: how much of the company's cash goes to its creditors and shareholders? Does it keep enough for its own investment and growth? The cash flow statement demonstrates where cash is being generated and where cash is being used in the business. The basic formula for a cash flow is cash at the beginning of the period, plus or minus all cash transactions during the period, to get the cash balance at the end of the period. However, most cash flow statement presentation uses an indirect method which starts with net income. Cash transactions are sorted according to activity types, starting with operating activities. Operating activities are the day-to-day activities of the business. They are revenues and expenses that have been collected and paid during the period. Cash flow from operations are computed by adjusting for items that were included in the net income that are non-cash, non-operating, non-recurring, and the changes in working capital. Adjustment is made for non-cash, non-operating, or non-recurring items. Starting with the net income, add back depreciation and amortization. Add back provisions and write-downs, but remove subsequent reversals. Add back share-based compensations. Add unrealized losses, but remove unrealized gains. Remove gain on sale of assets. Add interest expense, but remove interest income. And remove dividend income received from investees. Working capital is simply current assets minus current liabilities. These are accounts that are affected by daily operations. Current assets have an inverse relationship to cash. An increase in current assets is a decrease to cash, while a decrease in current assets is an increase to cash. For example, when accounts receivable decreases, it could mean the customer has paid their dues, which adds to the company's cash balance. On the other hand, an increase in inventory could mean the company bought stocks but has not been sold yet. This reduces cash. Current liabilities have a direct relationship to cash. An increase in current liabilities will also increase cash, while a decrease in current liabilities will also decrease cash. For example, an increase in accounts payable could mean the company delayed payments to its suppliers, keeping more cash on hand, while a decrease in accounts payable could mean the company paid its suppliers, causing an outflow of cash. Investing activities are purchases or sales of long-term assets that support the business, like property, plant, and equipment, and investments. Cash flow from investing activities includes the proceeds from sale of assets, purchase of additional assets, and changes to other long-term assets. Proceeds from the sale of PPE or investments will cause an inflow of cash into the company. Collection of loan principals, such as notes receivable to subsidiaries, will also contribute to an inflow of cash. On the other hand, buying additional PPE, new investments, or new business acquisitions will cause an outflow of cash from the company. Extending loans to other companies, like a subsidiary, is also an outflow of cash. Other cash transactions that can also fall under investing activities are dividends received from investments and interest received from loans extended. Financing activities are related to raising cash from investors and lenders and subsequent repayments. This is in the form of shares and debts. Cash flow from financing activities include issuance of shares and availment of loans, plus subsequent payments related to shares or debts. A company can raise funds from issuing common shares and preferred shares. It can also raise funds from borrowing money, like from a bank, or by issuing its own bonds. Any of these will result in an inflow of cash. A financing cash outflow will result from repayment of loans and debts, including interest expense on those debts. Distributing dividends to shareholders will also result in an outflow related to financing. And also, buying back shares is a financing activity that will cause an outflow of cash. Let's recap. Net cash needs to be explained. What happened during the period that made the cash balance go from $571 million at the beginning of the year to $616 million at the end of the year? This is the primary purpose of the cash flow statement. It explains where cash came from and where it was used by grouping it into operating activities, investing activities, and financing activities. Here's a cheat sheet to help you remember all these. Operating cash flows is the adjusted net income, remember? Remove non-cash, non-operating, and non-recurring items, and changes to current assets and current liabilities. Investing cash flows will come from changes in non-current assets. And finally, financing cash flows will come from changes in non-current liabilities and equity. Thank you for watching. If you liked this video, please like or subscribe to my page and channel. See you on the next one.